for those of you who like straddles, clearly you can use this on anything. This is kind of a quick and dirty way of making an estimate of what what would be your maximum loss and what kind of win rate that you would possibly need. And just for the purposes of discussion, I did a hypothetical thing here for what might be some straddle results using 800 of margin. And there are 20 trades here. And you can see that if you make around, anywhere from 55 to 65 bucks, you're actually getting a pretty good return on that margin. Now, let's say you had 3 losers and you let one of them go to 110, that's 13.8. Let's say you let one go to 130, 16.3% loss. And you had 3 losers, this other one's 120. You'd still have an 85% win rate. You'd still net out 768, and you'd still have a good expected return, and you'd still have a fairly decent sort of percentage of return on your margin. But let's say that you decided to allow a much wider loss, but if you kept the gains the same. So let's bump these up to 150, and let's say you still had only 3 losers. Well, you're still making money, but that actually dropped you a lot. So then the other consideration is some people say, well, I'll just have a really tight stop and I'll get out of these at only $50 of maximum loss. Well, what's going to happen then is instead of only having 3 of these, you're going to have a lot of losers. And so unless you increase the average win, which is a little difficult to do for the straddle the way that I play it, unless you increase the average win, but now you have several losses, even though they're only $50, you're going to really, really degrade the expected return. And so then the final comment is the way that many people play straddles is they'll allow them to go through earnings, and that can work. You're going to have relatively few winners, and you're going to have mainly all losers. You might only have, instead of a win rate of 85%, you might only have a win rate of, say, 35 or 40%. So in that circumstance, the only way to get a positive expected return is, I think you guessed the answer, you have to have a really, really big win on the ones that win. So in other words, the underlyings that you choose, when they move following the earnings release, they need to move a lot, and they need to counter the loss that you're going to take from the drop in volatility. So instead of these being 60 and 70 and 65, you'd need 150, 200, maybe more, because in this column you're going to have a lot of losers. So that's the way expected return works for those of you who haven't really played around with this. And if you are a subscriber and if you've not played around with this, I would encourage you to do so, because I think you'll agree with me, Tom, your expected return, that's the key to being a successful trader. I don't really care if somebody says, oh, I made $5,000 on that trade, and then the one before that I made $3,000. I'm a genius. The only thing that matters is what is your expected return.
Right. It's like you don't want to go to the casino unless your expected return is positive.
Yes, because they will take your money.
Yeah, their expected return is positive, which they love. So
yeah, see, yeah, they know all this.
Right.
I mean, I looked up a website once of the casino calculations for the way that they set their machines, and they are using a log normal. Well, I don't know if it may not be log normal, but they're using a bell curve. So they know. I mean, they know what's going to happen, and they set the machines accordingly, and they set the betting structure accordingly. So they're not going to lose.
No.
And so we want to be the casino. So so if you are doing straddles, if you do them my way, if you like my way, and if you wanted larger size, then experiment with these numbers on either side and work out for the size that you're comfortable with. I'm very conservative for the purposes of the class, so I use a small size. But if you wanted a 10 lot or a 15 lot or more, work out some numbers and make some decisions, beforehand of what you want to allow your maximum loss, that you're going to allow your max loss, because that's going to directly impact your expected return.
Well, and I built a trade simulator a long time ago that lets you kind of test out your parameters, and I don't know,
Right, and it's yeah, and it's a good one. I think we have shown that before. Let's see here.
if you go to the member site and then tools.
Member site and tools. And
then
it's right
trade,
up here someplace.
yeah,
Yeah,
there it is, trade
it's right
simulator.
here. And this is really good. I mean, you don't have the details that I just showed you, but you can factor in really pretty much everything else. I mean, you can factor in the win percentages you're going to get, and you can factor in your losses.
If you want to set a fixed win or loss percent, just make the range like 9 to 9 or 5 to 5, whatever you want to fix it to. Otherwise, it'll pick a random number between your range every time. But then you can set, what's my win percent? How much overhead do I have with commissions? And then the moving averages, that's a nice trick from Joe. If you plot out an equity curve of whatever strategy you're trading, and that equity goes below the moving average, then he goes to paper trading until it goes back above the moving average, then he goes back to live trading.
Well, yeah, and this is a very nice tool. I have used this one so much, even at a different, even when it was available on a different venue website. I've used this a lot, and it really will reshape your thinking. And what Tom was talking about, if you want to have a fixed range here. So, for example, we'll just set this to the 15% that I used there, and
say like 8% on the wins, 8 to 8.
8 to 8, and we could just leave the same 10,000 if you want.
Yeah,
and
say recalculate.
Then you recalculate, and so there it is. So you see, this is obviously profitable over time, but
look
if
at
you
look at the probability of ruin down the bottom right.
Right, yes. So this, I mean, this is another way to interpret what we were saying earlier, that if you allow the maximum loss to increase, you're going to be toast. And if you don't maintain at least an 8%, you're going to be toast.
And another thing you can do is, this shows 150 trades, but you can do a basket of 150 trades or multiple baskets. So if you set the number of trials to say 10 up at the top.
Oh yeah, yeah.
10 or 20, whatever, and then hit recalculate, that's going to run that 150 trade 10 times and show you the maximum and the minimum and the average of all of those trials.
Yeah, I had forgotten that. I used this, but I actually forgot that. But that's a very useful feature. And so you can, I mean, you can do the same sorts of things that I showed on the spreadsheet. You can do it a lot more quickly here. You may not have the granularity for the individual trades. The reason I set up the spreadsheet is because you can obviously use that with, real money. In other words, if you really did 20 of these, then you'd go ahead and put those real numbers in, and then you'd have the real numbers of this. But for but for understanding the implications of the trade strategy and the way that you're going to set up your risk to reward ratios, I think this is ideal. And really all good traders will do this, whether they're futures traders, whether they're day traders, they'll all do this. I mean, because you have to know what you should set as your stop, which in this case would be the loss on losing trades. You have to know what that number is.
And one thing I always liked about this one is that this shows that having a basket of different trades is actually very beneficial, because you can see how smooth that black line is. The green and the red are fairly jagged, but the black one is very smooth, and that's the average of all of them. And it just goes to show, if you have enough capital to divide your portfolio up into different types of trades, it's not a bad idea.
Well, that's right, and you can also see very quickly at a glance. I mean, if you just move the loss numbers up, quite a bit of variability now.
And if you just set it back to one trial, then it'll show a lot of the analytic data for one set of 150. So now your probability to ruin is almost 50%, which is crazy.
Yeah, and see, you'd had a big drawdown there.
Right.
So yeah. Thanks for reminding me to show this, because I have shown it once before, but not in this particular context. So for those of you who haven't already done this, I know we have a lot of experienced people, but I know we also have some people who are relative newbies. And this is not I mean, we've got what, 20, I don't know, 27 people on this or something.
Right.
So this is not as large a group as the road trip, and I don't really have a feel for the level of expertise range in this group as much as I do in the road trip trades. But I think that some people are fairly sophisticated and some people are newer. So the people who've been trading a long time, they already know this, but the people that are new, yeah, I can't emphasize enough, and I think Tom will agree. I mean, this is really one of the most important things of trading. I mean, sure, it's nice to know setups and how to adjust, and obviously that's important. But unless you can get a good curve, without a lot of drawdown, I mean, you'd have had a period here where you'd be saying, wait a minute, what am I doing? You would not have been happy here. So unless you can generate a good curve, then you need to rethink the strategy.
Well, and imagine if you had just started trading that strategy right before that big drawdown. Would you have the fortitude and strength to keep going after you had that much of a drawdown?
Yeah, exactly.
I probably wouldn't be convinced that this is a winning system.
Well, no, I mean, up until this point here, number 90 okay, or whatever, it looked really good. But then you see it is really not.
Right.
Which is why you have to have enough trades here. And you don't want to just put 10 trades in here. You want to have a lot of trades so that you know if the system is really good. Thinkorswim has something really nice, not for straddles, but for stocks. They have a bunch of strategies on there, and you can write your own strategies, and you can actually write in the code the entries and the exit points and the stop points, and you can run like a year or 2 years, and then you can export that to the spreadsheet, and you can actually add up in real numbers what that strategy would have done for you. So it's the same thing. If you were doing that with, say, long stock, and you had certain things like I have that are key things that I use on day trading, and you factored those indicators in and ran the strategy, wrote the think script and ran the strategy, it'll calculate it for you, and at a glance, this is not going to work over time, or this is a pretty good strategy. It's making money over time, and this is the same sort of thing here.
Right. All right, Dan. Glad we went over that.
Yeah, me too. Thanks for reminding me to show that again. And so, again, for those of you who haven't played with this and the spreadsheet, I would encourage you to do so.
Okay, Dan. Well, thanks again as always, and you have a great weekend.
Well, you too, buddy, and we'll see everybody next week.
All right. Thanks.